Hello? Can you guys see this now? Like, is this a thing? Did I just do the entire stream for no reason? Did I just do that? You guys can see it now and hear me now? I can't believe it. Guys, I'm starving. It is 10 p.m. in Brazil right now, and I just did this entire thing. 50 minutes. I'm going to do it again. Fuck it, we'll do it live. What a... Man, technology. Just give me a... somebody in here give me in chat on YouTube the thumbs up that you can hear and see. Okay, man, what a... All right, let's do it again. I'm going to be a little less enthusiastic, maybe a little bit more of an asshole, but we'll get through it, all right? Okay, without further ado, guys, what the hell is Wyckoff for the second time? We're going to go through what the Wyckoff Market Model is. We're going to go through a little bit of the stage analysis via Stan Weinstein, and we're going to talk about how you can use it to improve your trading. Okay, it's not that big of a deal, but it's also probably one of the most important things you're ever going to learn as a swing trader, position trader, or long-term investor. And if you're a scalper or day trader, understand that these market cycles do play out on all time frames. They're just generally going to be used for higher time frames. Okay, within that construct, if you don't know Wyckoff Market Model or the Stan Weinstein stage analysis, some of the biggest trades you're ever going to take are going to be buying those stage 2 breakouts and holding through the majority of the trend. Even if you have no idea what this stuff is, that is going to be your biggest trade ever eventually. Statistically, those are where your biggest trades are going to come from. So if you survive a few market cycles, you're going to be buying somewhere in an accumulation phase, and you're going to be closing somewhere in a distribution phase for hundreds of percent spot, thousands of percent in options contracts. It will happen eventually. Statistically, it's proven. So that's what we're going to try to focus on. How do we find those stage 1 accumulation phases into stage 2 buying opportunities? How do we identify those stage 3 distribution phases and either sell our stocks or short those stage 4 markdown periods? All right, let's talk through it. The objectives here. Once again, I just did this for 50 minutes, so bear with me here. I'm losing my voice already. We're going to talk through what the Wyckoff Market Model is, the 4 phases of the model. How can you utilize the phases in your trading? We're going to intertwine the Stan Weinstein's version of the Wyckoff Market Model. He calls it stage analysis. And then we're going to look at current examples of stage theory in the market. What is Wyckoff? The Wyckoff Market Model describes the market behavior by identifying 3 fundamental laws: the law of supply and demand, the law of cause and effect, and the law of effort versus result. That's a fancy way of saying lots of different market forces, and he's trying to quantify all of it and spit out trade ideas. We talk about this stuff inside of TTI all of the time. So you're going to notice a lot of the stuff that I'm about to talk through over the next 15 minutes. We have different names for it, different how we trade it. It's going to be slightly different, but they're all outlined over 100 years ago by Richard Wyckoff. Lastly, the most important part of his Wyckoff Market Model is this 4-phase market cycle of accumulation, markup, distribution, and markdown, where traders aim to align their trades with these large institutional market cycles. Because let's be honest, retail traders don't move the market. I'm sorry, but we don't have enough money. The people that move the market are large institutional buyers and sellers. And regardless of whether or not you hate Mr. Banker, you hate Wall Street, I like money more than I hate them, and therefore, if they're pushing the market in a certain direction, I'm just going to join in, right? We got to find out where they're doing it, though, right? So this is the basic Wyckoff price cycle. Everybody's seen this. Thank you, stockcharts.com. You have your accumulation area, your markup, your distribution, your markdown. This looks incredibly simple because it is incredibly simple. By design, by the way, the market oscillates. It goes up, it goes down. Hopefully over a long enough sample size, it goes up more than down, right? Your distribution areas over the course of 10 years, 20 years, 30 years are going to be higher each time, representing a long-term uptrend. If you look at the S&P 500, you look at NASDAQ, etc., they move in these price cycles, but each distribution area is going to be slightly higher than previously, and your accumulation area is also going to be slightly higher in a primary uptrend going years, decades, etc. In a downtrend, you're going to see distribution areas significantly lower each time, accumulation areas significantly lower. You get the general gist, right? But all markets oscillate within this idea of accumulation and distribution areas. The markup and markdowns are our trading opportunities. we don't necessarily want to trade the accumulation or distribution. So let's go through it. Let's talk about the Wyckoff's 5 laws first. So because this is the second time I'm running through this within the last hour, I realized that I probably should have added a couple slides, but since it took me 50 minutes, let's be honest, nobody needs more slides. So I'm just going to say it now. The Wyckoff Market Model was brought about over 100 years ago by Richard Wyckoff, and it was extensive. He was one of the very first technical traders. As a matter of fact, he says he does not care about any fundamentals whatsoever because by the time fundamentals hit the market, meaning for us, retail traders, price is generally already going to reflect that type of information. Essentially, he's saying people that are rich have information faster than people that aren't. And yeah, we can probably agree that that's true, right? So his stuff was very rigid. So what we're about to go through, once again, I need to point out, some of it's phased out. We understand that edge loses edge over time. The market tends to phase stuff out. Richard Wyckoff's general ideas stand the test of time. Stan Weinstein extrapolates on them, but some of the stuff you're about to read right now, take it from a higher level point of view, okay? So the Wyckoff method involves a 5-step approach to stock selection and trade entry, which can be summarized as follows. I'm just going to read them verbatim, baby. Determine the present position and probable future trend of the market. Trend matters. Richard Wyckoff knows that. Select stocks in harmony with the trend. Well, TTI traders, that means buy the strongest stocks if the market's in an uptrend, and sell the weakest stocks or short them when the market's in a downtrend. Richard Wyckoff said that over 100 years ago. Still makes sense. Select stocks with a cause that equals or exceeds your minimum objective. It's a fancy way of saying look for big bases. We'll go through that in a second. Determine the stock's readiness to move and time your commitment with the turn in the stock market index. Essentially, he's saying don't trade against the primary trend, you dumb. It's incredibly challenging, and that tends to still be the law of the land. Determine market trend. That's the number one thing. It's the number one thing for every technical trader. Your number one job as a technical trader is first and foremost to identify the trend. It doesn't matter if you're trading with it, if you're trading against it, what type of trading you're doing. You have to be able to identify as a technical trader which way the market is moving. You have to on every time frame that you're trading. What is the present position and probable future trend of the market? Are the indexes hitting a series of higher highs, lower lows, or simply consolidating on the weekly time frame? Now, Richard Wyckoff was trading on the daily, weekly, monthly. Inside of TTI, we're generally trading on the daily or weekly. If you're trading intraday or within a week time frame, it's all going to be the same. Technical analysis is fractal in nature, meaning it doesn't matter which time frame you're looking at. A series of higher highs is an uptrend, a series of lower lows is a downtrend, and a horizontally channeling range of price action is no trend. And so Richard Wyckoff 100 years ago said, it matters. Figure out which way things are moving. Let's add a couple things, though, because he didn't have stuff like a 200-day moving average over 100 years ago, or some of these momentum indicators, right? Is price above or below the 200-day moving average? And is the 200-day moving average sloping up, down, or horizontally? It's a great way to help you determine trend. If you cannot look at a chart and determine it based off of price action, there's no cheating. It's totally okay. Pull up a 200-day moving average and see where it is in relation to where price is right now, and whether it's sloped up, down, or horizontally. And then also you can use any momentum indicator you want. We use the relative strength index. Essentially what we're looking for is a trend above or below the neutral value, or if it's at the neutral, there is no trend. So once again, find a way to determine the market trend. I just gave you 3 or 4 different types of ways to do it. Pick one or do all 3. Number 2, stock sharing the trend. Which basket of stocks is moving in tandem with the trend? Well, if you're in TTI, you know we buy off of sector and industry groups. Stan Weinstein said it was the number one edge in the market in the 80s. Bukowski says it's one of the number one edges still in the market. And 100 years ago, Richard Wyckoff, although he didn't clearly say buy the industry group, idiot, he realized that types of stocks tend to move together and there is strength in certain baskets of stocks. So what we're looking for in an uptrend is stocks determining greater percentage moves than the market during rallies and smaller reactions during corrections. What is that called? Relative strength, baby. Relative strength. Third pillar within TTI. It's the most important thing in my mind when you're looking at baskets of stocks is which ones are outperforming the rest. Wyckoff said the same thing. Let's throw out a real world example right now. You're watching this. It's November 9th, Thursday, 8 p.m. Meta. Right? The market just corrected from the end of July through essentially the middle of October, end of October. What held up the best out of the mega caps? Meta was one of them. It went sideways as the market came down. Richard Wyckoff would look at that and go, that is relative strength, baby. That's what I want to buy if the market starts to go back up. And guess what? That's why we bought it, because the market is maybe starting to go up. We'll see. In a downtrend, look for stocks that are weaker than the market. That goes against most people's biases. They don't understand that, hey, you should be shorting the weakest parts of the market. Most people want to look for all-time highs and short those things, but let me tell you something. That is a losing game, baby. There's a reason why that stock's at an all-time high, and it's not because there's a lot of room underneath. Most of the time, stocks at all-time highs are there because the market wants them there, and they're not going to give huge 60, 70, 80% sell-offs on average. On average, the way to short the market is to short the weakest stocks that are already down 50% as the market starts to break down. Because guess what? As famous TTI trader Robin says, stocks can always go down another 100%, which is true, right? So if you can't tell, drop it and move on. That is probably one of my favorite things he says, because you can use that for everything in the market, right? Stock sharing trend. If you can't tell, drop it and move on. If you don't know which way it's going, just there's 8,500 stocks you can scan through right now. Go find something else. There's going to be something else, okay? The bigger the base. This is the one that I really like, and I think where most people get it wrong when they're looking at the Wyckoff market models, stage analysis, etc. It's important to select the right stocks to meet your criteria. You got to look for large accumulation consolidation phases when going long. What does that mean? If an accumulation phase lasts 2 weeks, it's probably not going to result in a very big breakout. That's how it goes. This is like TA 101. You go through your CMT level 1 course, baby. You look for nice, long, large accumulation or consolidation phases because you expect on the breakout that the bigger the base, the bigger the breakout. You can see that's bullet number 3. Look for shorter periods of distribution or consolidation phases when shorting. Why? Because, well, we're going to go through an example in a second. Long distribution phases can often recorrect into new accumulation phases. That sucks. I've done that a lot. I've shorted the healthcare sector a few times and lost every time. We'll go through that in a second. But generally speaking, you want big, long bases, right? We're going to talk through what that actually means, and I'm going to show you what it means. But look for the big, long accumulation phases, and generally the distribution phases are going to be shorter, okay? Take the trades that are about to move. This always gets me. You'll see people on FinTwit and other places talk about trades, and they, this trade looks good, this trade looks good, and you ask why, and it's like, well, it's doing this. And I'm like, look at all of the other stocks that are exhibiting the same characteristics, but they're already moving. People are under the facade that if a stock is already moving, they've already missed out. And what they don't understand that is if a stock is already moving and you can find a relative area of risk, you should be that stock because the market is already telling you that that stock is moving, right? And that's what Wyckoff also says. This is his entry mechanism. And this is where some of the stuff starts to get dated a little bit. So I took the liberty here of kind of giving you, I'm going to give you his name, spring, up thrust, jump across the creek, fall through the ice. And I'm going to give you our spin on it, kind of the current way that people are trading this. So take this with a grain of salt. And this was where Stan Weinstein and Richard Wyckoff start to deviate. So Richard Wyckoff says that looking for trades primed for big moves, transitioning to another phase, one thing he looks for longs is something called a spring. We're going to call it a bear trap. What does it mean? At the bottom of an accumulation phase, price is going to undercut the lows. What are most people going to do? It's a new low after being in a horizontal consolidation range for, let's say, a year and a half. Most people are going to what? Short it. I've been there. I'm an idiot. I've been there. I've been trading 14 years. I've done that. What happens? Well, a lot of the time, it powerfully reverses to the upside, shoots through the accumulation phase, and ends up resulting in a stage 2 breakout. It's a bear trap. All that liquidity is trapped underneath an accumulation phase, and then you get squeezed to the upside. He's looking to identify those springs, those bear traps, and then buy off of those types of events, right? So he knows that that is a very powerful reversal indicator. Upthrust, also known as bull traps. It's the exact opposite. It's when price pops up over highs, powerfully reverse to the downside, right? From failed moves come fast moves. Remember that. From failed moves come fast moves. That's a great thing to remember. Let's talk about jump across the creek. We call it gap and go. I was trying to think of a way to talk about this, but essentially it's when a price gaps up and over overhead supply in an accumulation phase and just runs. Jump across the creek. What are you looking for? You're looking for strong breakouts with very little pullback, up and over overhead supply. It's generally going to have a catalyst, power earnings gap, something like that. Well, conversely, fall through the ice. What do we call that in TTI? Capitulation, baby. That's what we want to close on inside of TTI when we're short. So price falls below range lows on high volume and then continues, right? So these are his 4 entry mechanisms. He has a couple other ones, but these are the 4 most popular. I did my best to try to give you real world kind of words to go through them. But once again, this is what makes the Wyckoff market model very rigid. He only enters off of those. So that has to happen before he enters a trade. In a perfect world, the indexes would break out or break down at the same time. From strongest moves come from the index, right? We understand that we don't want to be trading against the major indexes. This is the last law. If the market indexes are showing signs of accumulation and a potential upward move is triggered, it makes more sense to be long, right? Like come look for stocks that it's time to go long. You don't want to go and buy the stocks that are still in the dip as the indexes turn around. There's a reason why they're still in the dip, because they're probably shitty stocks. Look for the stocks that are setting up for breakouts as the index breaks out. There's a reason why they're setting up. There's a reason why they're being accumulated. That's why it makes no sense to me to go and bottom fish in strong markets. They're bottoming for a reason. It's because they suck. They're going to move with the index, but they're going to move at a slower rate, and they're going to underperform the names that are setting up. It's statistically proven. Go buy the stocks that are setting up to follow the indexes. Conversely, if the market index is showing distribution, short the weaker stocks. We talked about that. I don't need to beat that into you again. Short the weaker stocks. Trust me. And if you don't trust me, I'll give you a website in a second to go and find it yourself. The synchronization aims to increase the probability of success. That's the thing right there. Increase the probability of success by trading with the major market indexes, right? I don't have to prove that to you. That just makes sense. Let's talk about the 4 cycles really quick. The 4 cycles within the Wyckoff Market Model represent different phases of the market participants' behavior and price movement, closely resembling the natural flow of market psychology and operation. The only thing I'm going to say there is market psychology is everywhere. Let's identify it and make money off it, both the good and the bad. This phase, accumulation, occurs after the market has experienced a downtrend and is where informed investors, which will now be called smart money, begin to accumulate shares over a period of time. They do so discreetly to avoid driving up prices too quickly, and the accumulation phase sets the foundation for a future uptrend as demand starts to overcome supply. I think the key word here is that institutions are looking to discreetly buy shares. They're discreetly building large positions. They do not want to influence price for 2 reasons. One, they don't want to have to buy shares at any higher of a price than they already are. And 2, they don't want to tip anybody off that they're accumulating. If your rival understands that you're looking to build a large position in here, there's lots of different sneaky ways to screw that up through financial derivatives and everything else. So big money, smart money, financial institutions are looking to build a range of price action to accumulate large amounts of shares. Let's actually look at what that looks like. Can you find the accumulation phase in this ticker GRAB? I'm still in a contract, just so everyone's aware that's in TTI listening to this. I don't know when you're going to listen to this, but your boy still got one. Accumulation phase, right? So what are we looking for? We're looking for a horizontal channel with a clearly defined supply zone at the top and demand zone at the bottom. It's pretty easy, right? Where's the rectangle? There's the rectangle. Let's define it. It's a tight range. It's horizontally channeling at the bottom of a downtrend. Volume is consistent, right? So once again, that goes hand in hand with discreetly grabbing a large share of the float here. Volume is consistent. Around ER it spikes, but you don't see steadily increasing volume throughout the accumulation phase. And the 200-day moving average is horizontal. Once again, that's just a great way to identify is the trend up, down, or sideways. It's sideways. This is an accumulation phase. So as a trader, you would identify this and go, well, I know where I want to be long, probably above $4. I don't have it labeled, but it looks like above $4 we're breaking range high. That's where I want to be long. Right now, it's just building a watch list. It's a stage 1 accumulation. Let's talk about the next step, though, when they do break out, markup. A following accumulation phase, once enough demand has been established to absorb supply, fancy way of saying more buying pressure than selling pressure, the price begins to rise. Woohoo, that's what we want, right? Enters the markup phase. This is often where the public begins to notice the improvement in the stock's performance and more participants enter the market, pushing prices higher. The smart money's earlier accumulation now pays off as the trend continues. Those goddamn asshole bankers and financial institutions and Wall Street guys, people that wear ties, they have been accumulating shares for months, potentially a year. Finally, market forces take over, price breaks out, and then you get the dumb people, us, we start buying. Yeah. That's actually how it works. It's FOMO, right? That's essentially what FOMO is. Now all of a sudden price is moving up and everybody wants it. These large financial institutions already have it. That's why we're looking to identify that area so we can get in before the rest of retail gets in. We're not fighting against the bankers. Leave that to the apes. I think they just bought the most expensive house in history. I think Jamie Dimon is building literally the most expensive house in history. Thank you, AMC. We don't care about fighting Wall Street. We're going to join them. Right, so we're going to find the stage 1 the accumulation phases, buy the breakout, and let retail take us to Valhalla. Can you find the accumulation phase and the markup phase here? Can you find the horizontal channel? This is a trade we're currently in. Is that a TTI? It's a crypto coin. Don't ask me what it is. I don't care. TA is TA. Any asset class that has buying and selling, TA will come into it. So let's look for a horizontal channel and then that markup period. Let's define these. Accumulation phase, pretty easy. Clearly defined supply zone at the top, demand zone at the bottom, excuse me. High volume breakout, which is important for Wyckoff. On top side of accumulation phase, sustained move with very little pullback. This is a patented markup period. This is what he would want to be buying, right? This is essentially his gap and go. Now, crypto doesn't gap because it never sleeps. Part of the problem. If you're a full-time crypto trader, it's a problem, man. You need to sleep more. But realistically, this is a gap and go. This is a lot of volume. Price pushes up and over overhead supply, and you have a new uptrend established. This is where Richard Wyckoff would like to establish his position around $90 and ride the trend for as long as possible. All right, so there's your markup. There's lots of stuff. We're going to look at stocks in a second that are exhibiting this. It's not going to be the only example. Distribution. So this phase is the opposite of accumulation, right? After a sustained uptrend, smart investors start to distribute or sell their holdings to the public. It's where banks are looking to offload their position before a major market pullback or a potential bear market, right? They're looking, and if you think about an accumulation phase being a tight range with a clearly defined supply and demand level, and price isn't really moving a whole lot, volume isn't really moving a whole lot at the bottom of a markdown, it's the same thing, but at the top of a markup. They're trying to offload their shares to retail traders before the entire market falls down. Now, I made a tongue-in-cheek comment earlier that I shorted healthcare a few times. This is a distribution phase. Look at it. We have the markup period coming into 2022, right? Where's the breakdown? Oh, I thought there was going to be a breakdown, so I took some shorts and I got blown up. I'm a man enough to admit that I lost a couple coins doing this. But realistically, this is how you would view this, right? Tight range, horizontally channeling at the top of an uptrend. Volume is consistent. 200-day moving average is horizontal. But if you remember one of those laws from Richard Wyckoff, remember what we said about length of base, accumulation versus distribution. So Einstein quote, definition of insanity, doing the same thing over and over and over, expecting a different result. I think most of FinTwit probably has that problem. I shorted healthcare, but I stopped shorting healthcare at the lows. Why? Well, because I lost two shorts as we started to break down. And then I realized that this distribution phase was way too long to keep shorting. This could potentially flip to an accumulation phase, right? And it hasn't yet, but this is a no-go zone for me and TTI. We don't trade this stuff. This is chop zone, and we're looking for a resolution to the upside or downside. I expected a downwards resolution, as most distribution phases do, but this one didn't, and that's okay. So now we're just sitting on the sidelines waiting for a resolution, upside or downside. How late is it to buy and do a markup period? That's a great question, and I'm going to answer that during the stage cycle portion of this. It's going to be in about 5 minutes. Yeah, it's a great question. Okay, so once again, that's how you identify distribution. That's when smart money is offloading shares into retail traders' hands, because retail traders' hands are expecting new all-time highs, and financial institutions are waiting for drawdowns or potential bear markets. Markdown, this is your shorting opportunity. You want to short, this is it. Once distribution is complete, the excess supply drives the market into a downtrend known as a markdown phase. Prices fall as sellers dominate the market. This is like every short seller's dream. This is kind of every trader's dream, to be honest. It's a lot of fun making money to the short side. It's incredibly challenging, though. I think most of you, including myself, would probably do a hell of a lot better if we stopped obsessing over trying to catch every short. We're not Michael Burry. No one's going to make a movie about us. Probably make a lot more money just going long off of accumulation phases. But listen, it's a lot of fun. So we're going to go ahead and define this. This phase will continue until prices have declined enough to spark new interest from smart money for another round of accumulation. This follows the economic cycle, which we're not going to get into today. But that's a whole other topic I could yap about. I won't do it right now. Where is the distribution phase and the markdown phase in this chart? Where is it? This is a trade that we took in TTI. This is your IWO small cap growth ETF. End of 2021. Before the market started to fall. So if you were trading back then, the market peaked in January of 2022 before falling. NASDAQ, SPY, but we had clues. IWO, small cap growth, generally going to be your riskiest part of the market in terms of risk sentiment and equities. It broke down in November, giving us a clue that the riskier parts of the market were already getting sold off and capitulating. Can we identify that? Of course. This is exactly how we did it. This turned into a great trade. High volume breakdown on the underside of a distribution phase with multiple capitulation candles. Now, I would be lying if I told you we held our short from November of 2021 until May of 2022. That's bullshit. But we did capture a few capitulation candles, and it was a multiple 100% winner to kickstart the bear market. Can't say we had the exact same performance on every short because shorting is hard. But if you can positively identify these distribution phases and short the markdown with some sort of throwback, you will make money. You have to be aggressive with these, and you have to be on your shit. And I need to emphasize that. If you're a full-time employee, a young professional, you own your company, it would behoove you to try to take as few shorts as possible, unless it's a hedge, because you got to be there. Any sort of rally is going to rip your face off, and which happens all the time in markdown periods. You can see this is not just a systematic move to the downside. There's a lot of chop. There's a lot of throwback rallies, right? Dead cat bounces, stuff like that. But the place to short is that distribution phase breakdown into the initial markdown, because that's where the market catches everybody off guard. They're not ready for the short yet. They're not ready for the potential bear market. So if you find yourself identifying a distribution phase, look for the first initial breakdown into that markdown, and that is where you should be keyed in on shorting. You don't need to short the whole move, trust me. So really quick, the data shows. Think about this. Which two combination of stages for longs do you think is the most profitable, and which two combinations of stages for shorts do you think is the most profitable? Buying which stage and selling which stage do you think is going to make the most money? And shorting which stage and covering at which stage is going to make you the most money? Told you, man, I'm all about stats. Actually, I think that was the first recording I said that. I can't remember. I'm all about stats. I made this slideshow as like viewer friendly as possible, but if you're inside of TTI, I talk numbers way too much, almost to the point where people don't even like care. They're just like, whatever, dude, you're probably right. So I'm going to show you the data. Why does this stuff matter? Think about it. Buying stage 1, selling stage 2, buying stage 2, selling stage 3. Which one makes the most sense? I'll show you. This is from Thomas Bukowski, the godfather of technical analysis, at least in terms of quantifying data. You can find all of his work at thepatternsight.com. He is my absolute favorite. I have been trading for 14 years, following his stuff for about 7. I still go every single day and review something because he is a nerd and willing to do all of this stuff for free. It's incredible. I highly suggest checking it out if you're a technical trader. But the data shows that buying stage 1 and selling stage 2 is the most profitable on average, with a 25.9% spot price move before any sort of distribution occurs at scale. Selling stage 4, covering stage 1 also performs the best at a 23% drawdown. So if you're shorting, right, if you can hold that full move, generally speaking, 23% down, but we know that the data might prove that, and holding that trade, especially if you're a put buyer or some sort of options trader, can be incredibly challenging because of expiration, etc. There is no time component to these stages. That's another reason why options trading is a little bit harder. We have to find the right expiration date to fulfill the price action we're trying to capture. That's why we get paid out a lot more than just trading equities. But if you're an equities trader like me, if you're a boomer, well, buying stage 1 and selling stage 2 generally nets you the largest win out of all of the other stages that you can do. That's why I said at the very beginning, your biggest win is going to come, regardless of whether or not you are aiming for it, buying a stage 1 breakout into a stage 2 markup and then selling it at the pico top of stage 2. Now, that is a tall order to say. And one thing I will tell you, when I first saw this data, I was a little surprised to see buying 1 and selling 3 underperforms buying 1 and selling 2. So I went back and back tested it a little bit, and then you realize, well, generally speaking, stage 2 is going to peak and then pull back slightly and then build a range. So generally speaking, if you're selling in stage 3, it's very easy. Once you understand what these cycles are looking like and what they're trying to do, if you have time on your side, you can sell in the distribution phase. Just sell you're not going to make as much as absolutely timing the top, but a 3 to 4% difference is not going to make a huge change in overall performance if you have a bunch of trades doing this, right? So don't stress over selling the absolute top if you're able to nail a trade, but I also want to stress, don't sell too early. Do not sell too early. Some of you guys are going to do it. You're going to have the best entry in the world. Maybe some you've already done it. I have a confession to make. My hands raised. I bought NVIDIA of January of this year, and I sold it in March. I am an idiot. This is a perfect example of that. I bought the stage 2 breakout and I sold it early. I will tell you it's because I didn't buy enough time on those contracts, but it's take unfortunately my missed profit as a way for you to not make the same mistake, right? So try to hold those great those great positions for as long as they make sense. So really quick, we'll try to wrap this up in the next 5 to 7 minutes. I want to talk about stage analysis because we just went over the Richard Wyckoff, right? And this is 100-year-old stuff. All the stuff I just taught you, he came out with over 100 years ago. And it's incredible that a lot of it is still applicable. A lot of it. There's some slight deviations, etc. We're adding moving averages. But for the most part, the overall idea works. Stan Weinstein came out in the 80s and wrote a book, and has since built a cult following around his stage analysis. What you're about to see is it's the same fucking thing as the Richard Wyckoff market model, except there's some tweaks, right? So let's talk about it because Stan Weinstein, he has a lot more access to better information, better indicators, etc. Here's the difference. Tell me, what's the difference? This is straight out of his book. Actually, it's not his book. I think I just lied to you guys. I don't know which website I got that off of. It's a terrible picture. Here's your stage analysis versus your Wyckoff price cycle. What's the difference? Looks like we added a moving average. Yeah. Other than that, it looks about the same. Unironically, that moving average is very important. We're going to go over it. So Richard Wyckoff did not have stuff like that. Let's go through the big changes. And let's talk about why they help. Let's talk about key differences first. Wyckoff market model places great emphasis on volume, particularly during shifts from one phase to the next, whereas stage analysis is more focused on the behavior of a long-term moving average and its proximity to price. I need to tell you guys something. Volume mattered a lot 100 years ago. A lot. There was not a whole lot of overnight trading. If there was any, when the markets closed, the markets closed. That was it. What about now? From a swing trading, position trading, long-term investing standpoint, the volume that we are looking to capture is outside of regular trading hours, and that's generally not retail trading. That's institutional trading, everything else, right? We're looking to play gaps in our favor over time. Day traders, scalpers, they need volume intraday to introduce volatility to buy high, buy low, sell high. Don't buy high and sell low unless, I don't know, maybe you're shorting, right? But it's less important from a swing trading perspective, and Stan Weinstein noticed that. He said he was more focused on what the moving average was telling him in terms of where price was, where trend was, etc. Volume was kind of a side thing, right? If there was volume, that's good, but it wasn't as important as Richard Wyckoff. And we've noticed that, by the way, over the last few decades, volume is less important in some of these types of breakouts that we're looking for. Number 2, Wyckoff has key triggers to enter and exit, right? We talked about it, spring, jumping the creek, etc. Stage 2 cares more about just getting in. He goes, I don't care. I don't need an absolute entry mechanism. If a stock is moving from stage 1 to stage 2, I want in if it covers everything else. He doesn't need a entry trigger. He just notices the stock is breaking out. He looks at the moving average. He confirms that it's within the basket of stocks that he wants to own. I didn't put this in here, but he's a very, very, very big industry guy, meaning he looks for relative strength within industries and then buys the key stocks within those industries. TTI. It's like 10. That's 10 at number 3 for us. I didn't invent this, right? It's been around for a while. So he cares more about just getting in than an actual entry mechanism. And lastly, Wyckoff is considered more complex, potentially outdated, while stage analysis is newer, more accessible, has clear-cut rules based on price action and moving averages. Once again, he cares more about market structure, trend, and moving averages than he does about entry mechanisms. And then also, listen, Wyckoff had 5 laws. There's a lot of stuff I didn't talk to you about within the Wyckoff market model that also needs to be a part of every key decision you're making. And a lot of that stuff is just, it's edged out. And it's not there. It's not relevant in the market anymore. So Stan Weinstein took those general concepts in the 80s, wrote a book, and people are still following it, including us. I mean, stage cycle works within a macro type of environment, right? Looking not macros and macroeconomic, but macros in like higher time frames, right? So let's talk about that moving average, because that is the key component, the key difference between the stage analysis and the Wyckoff market model. He uses the 30-week moving average. It's like 200, 210 days, something like that. Long enough to smooth out short-term fluctuations and highlight intermediate trend. Right, come on, we're swing trading. Within TTI, 45 to 90 days out, sometimes 120 days out. We're looking to hold some positions. We're not looking to get in and get out within the same day or even the same week, unless it's a terrible trade. We don't want to do that. Stan Weinstein said the same thing, man. He's looking like weeks or months out. He wants an intermediate trend. He's not looking to hold things for years. He understands that generally these cycles don't last for like 3-4 years. They'll last, 2, 3, 4, if you're lucky, quarters. And so that's what he's looking at. He says the 200-day moving average is a great way to identify that intermediate trend. And then also long enough to smooth out all the short-term bullshit that we don't care about as swing traders. Day traders, you need it. I feel for you, man. Feel for you. But swing traders don't. We don't need it. We don't need to worry about short-term fluctuations. Okay. Institutional bias, right? Everybody knows that these institutions use the 200-day moving average, not necessarily to make buying or selling decisions, but generally speaking, can we all agree that stocks above the 200-day moving average tend to go up more over time than down, and stocks below the 200-day moving average tend to go down more than up? I mean, that just makes sense. It's called trend. And he identified that in the 80s and said, why are we not just utilizing the 30-week moving average to see what banks are seeing? Banks want to be buying stuff that are going up and selling things that are going down just like everybody else. So that's why you did it, right? Acts as dynamic support during stage 2 uptrends and dynamic resistance in stage 4 downtrends. So this answers Dylan's question about how do you get into a markup period if it's late. I'm going to show you what a dynamic support is. And horizontally chaining 30-week moving averages confirms base building. Just another way to figure out, are we in accumulation or a distribution phase, right? So what is the 30-week moving average doing in this? This is grab. Once again, we've already said this is an accumulation phase. A lot of people would say, this is the trend's moving up, the trend's moving down. Like, they have to have an opinion. And realistically, is the trend really doing anything? You don't have to overthink this. Don't overcomplicate this. It's not doing shit. It's doing nothing. It's going sideways. It's a neutral trend within an accumulation phase. So Stan Weinstein would add this to a watch list, and he would say, I want to own this above $4 with the indexes breaking out at the same time, or at least the industry group breaking out. Until then, I don't want to touch it. The 200-day moving average, or the 30-week moving average, is not doing anything to give me any sort of reason to own this yet. It's a nice stock. It's building a big, long base, but it's not there yet. And I have egg on my face because I have a contract in that. Do not buy unless the 30-week MA is below price. I should have probably said you should buy when price is above it. It's the same thing, but it sounds better. But you want the 30-day moving average below price, meaning price is trading above it. And you want that 30-week moving average sloping up during the breakout. And we're going to see some examples of that. And I want you to think about that. I'm going to go over it in a sec. Why does the slope of the 30-week moving average into the breakout matter? Think about that as we're going through these slides. Can you find the accumulation and the markup phase for Uber? This is a trade we're in. This is the second time we've traded it this year. Look at this for about 3 seconds. Think about what an accumulation phase is, what a markup phase is. Accumulation phase, we're looking for some sort of horizontal channel, some sort of rounded bottom, some sort of reversal where smart money is buying, and then the breakout, right? So let's go ahead and look at it. Here's your accumulation phase. This is how we played it inside of TTI. So if you actually scroll out and look all the way to the left when Uber actually IPO'd and got listed, this accumulation phase is essentially the bottom half of price action. So it was perfect at the time. We said, hey, if it breaks back up and over that, we're trading in the upper 50%. The uptrend is probably valid, right? That has nothing to do with Stan Weinstein, but hey, confluence. So we're looking at this accumulation phase. This took about 14 months, which is about right? We said the bigger the base, the bigger the breakout. We want time on this. We want to see institutions coming in. Look at the volume. Concentrated around ER, but other than the ER events, very consistent, showing that once again, institutions are accumulating a position. And look what happened about 3/4 of the way through the accumulation phase with that 30-day moving or 30-week moving average, right? I was just asking you about the slope and what does it matter during the breakout. The 30-week moving average acted as dynamic support in the middle of an accumulation phase. Price broke up off of a positive ER. Doesn't matter what the catalyst is, but it's nice to see a positive ER. It's called a power earnings gap for those of you that trade those. Wyckoff would say this is a gap and go. And the 30-week moving average is sloped up. What does that mean? It means that price has been trading above the 30-week moving average, which, by the way, is a very long-dated moving average. It's been trading above it so long that we have now influenced the slope of probably the longest term indicator you're going to use. And if that's the case, the odds, the probabilities of the trend continuing are maximized. If price breaks out with the 200-day moving average, the 30-week moving average, horizontal or sloping down, the odds of that continuing in the direction of the breakout are nullified. I'm not saying it can't happen, but it's greatly reduced. If the 30-week or 200-day moving average is sloped up into the breakout, it's telling you the price has been trading above that key zone for so long that we are now influencing the overall trend, and more so where the probability of the uptrend actually holding the breakout and continuing is higher. This is a very simple trick, by the way. Even if you don't trade the Stan Weinstein stage cycle, Wyckoff Market Model, moving average slopes matter. Okay, so if you just add any of that into your trading whatsoever, it's incredible. You can back test this. It's great. Let's talk about the markup phase really quick. So this is a trade that we took above 37.5, right? And it did nothing for a month. And this is typical, by the way. So have an expectation for what the trade is going to do. That's what makes options trading sometimes very difficult, because you have to have an expiration on it. If you're trading equities, what is your opportunity cost of holding a sideways moving stock in a market that's ripping? Well, you might not be losing money, but you're certainly not making it. And that is potentially a net loss. If everything's ripping and you're in the one thing that's not, that can be very frustrating. It could lead you to closing out of a really good play early, etc. From an option standpoint. We held this thing for a month before it moved, and premiums slowly depleted, right? Due to theta decay, IV decay, etc. And then we got the massive continuation of the trend. So understand that although the Wyckoff and the Stan Weinstein models, they work really well on a macro standpoint, you have to set your expectations, root them in reality. Don't expect these things to break out and run to all-time high in 3 days. It's not how this shit works. If you're a swing trader, you shouldn't already be thinking that. So Uber took 1 month damn near to break and continue up. And this has nothing to do with Stan Weinstein, but what is that? That's a simple resistance turn support flip with a base built on top of previous resistance. That is very bullish, by the way. Nothing to do with Stan Weinstein, but here we go. Markup period up. We sold into the 47.5 price target, and here we are once again. So we had a question. How do you get long a stock if you miss the initial thrust up? Happens all the time. Happens all the time. You get long via Stan Weinstein off of some sort of dynamic support, and he would say the 30-week moving average. Now, let me ask you a question really quick. Hypothetically, Stan Weinstein lives and dies by the 30-day moving average. I have mixed emotions specifically just using that. What is a different type of dynamic support that we could potentially use to get long, strong stocks in little corrective drawdowns before resummation of the uptrend? Could it be the 50-day moving average? Maybe even the 20, depending on how short-term you are. I mean, doesn't that make sense that the 50-day moving average is going to act as a better dynamic support within the intermediate trend nowadays? I mean, stocks move way faster now than they did in the 80s already. So the reason why I bring this up is if you hold the stock, and a lot of us are trading options now, if you hold that play from the peak of the first oscillation up in the markup and you wait for it to come back down and retest that stage 2 as dynamic, or the dynamic support, the 30-week moving average, most of your options premium is fucking gone. And your equities, the profits that you grabbed off of the initial accumulation phase, you could be down 90% off those profits. So you have to be very, very patient if you're going to use that. And so within TTI, what we do is we use that more so as is this trade idea invalidated at this point if we break back down below it? But we will use a shorter term moving average or some other type of construct to add in. And so to answer your question, Dylan, what I would do is I would experiment with the time frame that you're trading on, use a 50, a 20, look for pullbacks in towards those upward sloping shorter term moving averages, and try to buy your original entry or an add, by the way, across those dynamic supports. I will tell you right now that entering into markup period is more challenging than buying the breakout, which is why it's so important to build a scanner, which I'm going to give you at the end of this. You're going to email me. I'm going to give it to you. How about that? Building a scanner to find these potential opportunities is the number one edge. Number two is obviously adding in if you missed it, or entering if you missed it, but that it gets more and more challenging, right? The more these times go on. So let's look at another one really quick. DraftKings. Similar setup as Uber. Can you find the accumulation phase? Look for some sort of horizontal accumulation pattern, and then look for the markup. This is a trade we also took earlier this year. I don't want to spend any more time, any of your guys' time, because I started late because I already did this for an hour before. So we're just going to scroll through this quickly. Accumulation, horizontal channel. It's yet again, it took about 14 months. Same idea as Uber. We bought the accumulation breakout. Right, you see the big thrust on high volume. It was a peg, right? Peg meaning power earnings gap. Get your mind out of the gutter. But then we had about a month of sideways consolidation once again with Uber, just like Uber. We didn't get stopped out. We never invalidated the breakout, but it challenged us to hold that position. And then what happened? We got the huge thrust up in the resummation of the trend. Look at the slope of the 30-week moving average at the breakout. Sloped up. The price was extended off of it. Great breakout. It's easy for me to sit here and tell you this was easy. It was not, but I will tell you that both trades ended up being in between 300 and 400% winners for the traders inside of TTI, but it was not easy. And so anybody sit here and tell, it's easy in hindsight to show you guys this stuff, but every day that price didn't continue the trend immediately, we're like, is this a fake breakout? Should we be looking to close this? So I'm not going into the entire reason why we decided to hold it. It has nothing to do with the stage theory, but that's why we got long this stuff. And so being able to identify these accumulation phases is going to be an incredible edge for you. And distribution, by the way, as well, when the market starts to top back out, getting out of good stocks for big profits or potentially opening up those capitulation type of shorts, huge edge in this stuff. So once again, dynamic support during stage 2, we didn't automatically pull all the way back to 2485, but 30-week moving average, Stan Weinstein would say this is yet another buy at a new breakout. This is, he would be all over this. We did not get long DraftKings again. We did get long Uber, right? So we got long Uber again today, actually, off of the 49 pivot. I'm going to go back really quick just so you can see exactly why. We got long today Uber. Maybe it works, maybe it doesn't. We like it above 49 because of the dynamic support during the pullback. We like it. There's relative strength there. Has that power earnings gap. There's a lot of juice in Uber. We hope that the market continues to give us the types of price movements we expect, which is to the upside. DraftKings we missed. We wanted to get long DraftKings as well, but there's only so many things in the market that you can own. Unless you're a billionaire and you want 100,000 positions, well, you have to make decisions. And unfortunately, DraftKings was one of those names that we skipped out on. But this looks great. I mean, this looks good. From a stage point of view, this looks like a continuation of a potential market period. So let's look at a few more, and then we'll call it a night. Is this an accumulation phase? This is a Solana FTX, Mr. Sam Bankman-Fried. This is his baby. Yeah, it's accumulation. What could make this more bullish? 200-day moving average sloped up. It is technically sloped up right now, but man, it would feel a lot better if it was sloped up a little bit more. This is a patented accumulation phase over the course of about a year and a half. It's the exact same thing. This is crypto, by the way. I want to point out that this type of price action occurs in all asset classes. It's the idea that larger financial institutions are trying to load positions before ramping price up. It happens across all asset classes. So here you got Solana against, Tether or USD, whatever you want to look at, sitting at $45. Above $45, is this an okay long? We think so. Why not? This is an accumulation phase, potentially into a breakout. 200-day moving average just starting to slope to the upside. What about this? Accumulation? Egg on my face because I have this position. Yeah. Was the earnings play a few sessions ago good enough juice to get long? Yeah, I think it was. Did this work out? We probably get stopped out tomorrow. No. I'm going to show you. I don't want to cherry pick only the stuff that works. Some of this is not going to work. You will get stage 2 breakouts that fall back into stage 1 accumulation phases. You will, especially if the indexes are not giving you the same sort of push. So I don't want to sit here and preach to you that this is the absolute. I'm not the guy on TV telling you that I'm going to make you $1 million just by buying stage 1 breakouts into stage 2 uptrends. Hello, these things can fail. But you need to be able to manage your losses. So where would you manage this loss? Well, we said inside of TTI, if we fall back down below the low of day on the initial pop-up, we don't want to hold this thing through the gap. There's a huge gap down towards like 75, 76. We're currently at 84. Options contracts would be down negative 100%. Your equities plays are going to be down 15%. Let's get out of it. Stan Weinstein wouldn't be mad. We took a crack at it. 200-day moving average is sloped up. Huge extension off of the peg. It just didn't work out. So once again, I'm showing you this to show you that it's not 100% what nothing in trading is, right? So hopefully you enjoy the honesty there behind that. How about this? Grab holdings. Once again, we talked through this earlier in a slide. Is this an accumulation phase? Yeah, absolutely. Is this ready to get bought? No. No, it's not. Anybody watching this, I still have a contract and grab. But no, you wouldn't want to buy this. Price is above 200-day moving average, which is a Stan Weinstein no-no. And it's sloped horizontally or maybe even down at this point, which is another no-no. So this would be something that you would scan for, add to a watch list as a potential stage 2 breakout above $4. But you would not touch it until it breaks above $4. All right? So I'm trying to show you here that you can scan for these. And you could build extensive watch lists of stage 1 accumulation phases and just throw alerts at the top of the range as they break, pull them up, look at the chart again, see the circumstances of why they're breaking out, and you can find these things at the breakout point. You can scan for this specific setup. You can. It's incredibly powerful. All right? So here's the anticlimactic end. I'm not here to sell you anything. But I will tell you, if you email me at hamiltondrips@thetradinginitiative.com, please spell initiative correct. I will email you a video of how to scan for these stage 1/stage 2 breakouts, the bases, the breakouts, etc. We talk about this in TTI all the time. The guys inside of TTI can do this with their eyes closed. But if you email me because you're here, I will send you the video. There's going to be no sales pitch. You don't have to pay me. Lastly, reach out to me on Twitter at How to Swing Trade. I answer DMs. I also want 2,000 followers. I'm at like 1950. Please, I need 2,000. It's an ego thing. But yeah, reach out to me via DM. It's easier to contact me there. And if you ask me legitimate questions, I'll answer. Dylan, the next time for DoorDash, does the entry price increase or would it would be the exact same level? The only difference I believe that we would want in Dash to re-enter is market pushing the same day. The indexes matter a lot. And so unfortunately, Dash popped up and then the indexes started to stagnate. There is one thing that Stan Weinstein doesn't take into consideration, and that's the dollar. I don't want to get into it right now, but the dollar kind of rules the market right now. So any day the dollar is going up, stocks are going to have a headwind or potentially sell off. We saw that today. And so unfortunately, we bought a grab, or DoorDash rather, a dash pop on good ER up and over overhead supply, and then the dollar started to kick in a little bit. So I'll take the exact same trade again when we get back up there. It's just sometimes the trade doesn't work in our favor. Email list, I'm not going to send it out on an email list. So just shoot me an email right now. If you're on the email list, you have my email, or just pause this right now and write it down. Okay? Follow me on Twitter, DM me if you need anything. If not, email me. I'll send you the video. I appreciate you guys. Enjoy your Thursday night. It's almost 11 p.m. here in Brazil. I'm going to eat dinner and go to sleep. I enjoy you. Any constructive criticism on this stuff, feel free. I'm a big boy. I like to do this stuff.